And then how are you guys finding the opportunities?
Everything Cody and I have done, and I think this is the most unique piece that Cody started with. He built a relationship with the seller, but they wanted to sell to him because they were bought into him and helping him get started.
You're setting up like lunch meetings, coffee meetings, and just going to them like, hey, how did you build this portfolio? Well, that leads to a relationship. Then obviously in some cases it leads to deals now or even future deals.
People who own real estate, they know other people who own real estate. When people want to move you forward and you're connecting with the right people in the space who own the type of things that you want to own, it all just flows.
Why raise debt versus do the syndication model? I know that the syndication model is very popular right now. Why did you guys decide to structure it this way versus that way?
Not a lot of people have done what we're doing, but I've talked with a lot of syndicators and not a single one of them knew how to do what I was doing. They said, that's what I want to do.
Hi, everybody. This is Jose Luis Morales. Welcome back to the Residual Real Estate Agent Show. This is episode number 98. Today, we have two very special guests. We have Cody and Christian. They are real estate investors in the multi-unit apartment game, both fairly young for what they've been able to accomplish. Christian owns approximately 67 units and Cody owns approximately 81 units. Super young guys, have done some creative stuff. So I'm excited to have you guys on the show. How are you guys doing today?
Pretty good. Thanks for having us on.
Yeah,
Thank
excellent. I'm excited to be here.
Yeah, same here. So for those of the viewers that don't know who you guys are, would you guys mind kind of just sharing who is Cody and who is Christian individually?
So I'm 22 years old, just turned 22 about a month ago. College dropout, got into real estate through being a real estate agent, ventured into becoming a rental property investor, and the rest is history.
29, took the exact opposite route of Cody. Graduated college, went into 9-to-5 land. After about 7 years of sales, realized that I am making money and not getting any wealthier. I bought 2 duplexes just conventionally with my earned income. Met Cody and he was already at 30 at that time. I was like, wow, there is a better way to be doing this. So swapped over into the creative financing side, left the 9-to-5, and my first 12 months of investing picked up 55 multifamily units.
And how did you both meet?
Both ended up working at the same real estate brokerage. We're no longer there. However, it was just right place, right time. We ended up going to a Grant Cardone 10X event in Florida together and bonded over that. We were looking at a duplex, actually. That was Christian's very second duplex, and deciding whether he should buy it or not, and he bought it. That was his ticket into buying with me later on.
Now, Cody, was there a specific event that kind of made you realize that you were on the wrong side of the game?
It wasn't necessarily like an event that I went to, but a moment in time when we had a 22-unit apartment complex that was seller financeable. It was written up for a client, and the client didn't have any money. And so they, of course, backed out. Well, the owner of the firm that I used to work for, that I'm no longer with, it's like, you should buy this. You should just we can figure out how you borrow the down payment. And this was 19-year-old Cody. So I was like, okay, I didn't know that was possible. Well, I needed a 1-week extension to come up with the money. And I didn't know where it was coming from. I don't even to this day know where it would have come from. I didn't have any clients or any family money that could help. So it would have had to been a mentor at the time to help me. But that didn't come together because I didn't get the 1-week extension that I needed for him to help me come up with the money, which killed my hopes and dreams. I was like, I went from not knowing I could buy to knowing I could buy and then having that taken away. So I looked on the market, typed into the MLS, owner financing, found a 12-plex, wrote it up and bought it.
And when you say borrow the down payment, like what does that mean for the viewers that maybe aren't familiar with that?
It was basically a hard money loan. It was private lending from just an individual. My mentor helped set up the private placement, but he made sure that I had to do the pitches. I went through all these pitches and failed a lot of them. But there's a point in time where you have to learn and get over difficult pitches that you don't know how to make yet. So it was private money. It was 12% interest. That gets a little bit expensive when you're borrowing 6 figures. The seller financed 90% of the purchase price, which was just over $1 million. So I had a $6,100 payment to them, and I had about a $1,250 payment to the person I borrowed money from, and it made a little over $10,000 a month.
That's gross, right?
Yeah,
gross. That's awesome. You mind kind of sharing what the pitch would look like for somebody that maybe has never done a pitch for raising debt?
The pitch then is a lot different than the pitch now. because as you get more confidence, you don't have to do as crazy of pitches to get people to want to buy into who you are. But back then, I didn't have any experience, no family money, no family, in the space. So I had to figure out, how do I overcome all the objections of, you've never done this before, you don't know how to run a property. There's all these different objections. You've never made more than $2,000 in a month. Why am I going to trust you to pay me $1,250? The fact that I've never done it before is the reason they should invest in this deal, because if I can't pay them back in 1 year, they get the property. No one else had structured an owner contract with this little down except for me. I was able to go and structure a phenomenal deal, and if I couldn't pay them back, they would take it over and they'd be in a phenomenal position.
How were you able to find the individual who actually did the financing?
I mentioned I had help as a connector. My original mentor set up these meetings, and I flopped a couple. My first pitch, I forgot what I was asking for. Oops. Don't do that. I forgot how much money I needed. I forgot the payments. I'm really good at math, but the very first time I had to make a pitch, you wouldn't know it. I had to stumble through that. He set up a few more meetings. He worked with me, and I needed that help to get the right connections, which is why I always recommend someone goes and finds a mentor who's done this before. I just had to make a few pitches.
And Christian, let's talk about how you were able to buy your first property.
Yeah, first property was the conventional way. I started with the thought of, oh, geez, I don't know anything about raising capital. I can wrap my head around 2 units. I don't know about 12. So when I left the 9-to-5 world, I had just bought my first duplex. This was the end of 2020. A city called Bremerton, Washington. Was able to buy it $30,000 down. It was just a conventional buy. And technically, it was a house with an ADU, but ran it like a duplex. It was a cool first deal. Met Cody, and Cody was like, well, that deal's awesome, but you can get the same cash flow with like half the spend in Central Washington. And I was like, well, I'm very interested in this. My first one was pretty simple. I just, I went to the bank. I had some savings. I bought a duplex. I wasn't sold on out of area investing. It's about a 3-hour drive to Central Washington. So deal number 2, that was a full renovation. Picked up a gorgeous location, really ugly duplex for $200,000. We decked it out, rented it. I think we get the highest rent per square foot that I've seen in Moses Lake now. I mean, we went all out on the reno. Bought me 2 duplexes, just enough income on those to cover my home mortgage. Next time Cody came into my office, he's like, well, what is your goal? I was like, well, I wanted it 30 units by 30. I'm at 4 and I'm 29. And that's when Cody suggested, well, I'm looking at this 38. If we bought that, you massively exceed your goal. And that was the point for me. I realized, I was like, wow, duplexes are cool, but when you can get creative and you can accelerate, there's a lot more you can do when you work outside the box.
Was that hard to accept at any point, having like this 19-year-old kid coming to you and saying, hey, look, you can make more cash flow here, or you can do this or that?
The nice thing with Cody is Cody could back it by the fact that he was at that time 21 with 30 units. Starting out, I was like, whatever he's doing is ridiculously better than what I'm doing. That took me a second to swallow. And when I talked to my wife about it, and I was like, I kind of want to follow Cody's strategy. Like, well, how old is he? 22. Did it work? Yeah, I'm in. The easiest sale ever for her.
At some point, you guys got to pay off the second lien holder. What has been the strategy there to kind of get rid of the 12% or 10% or whatever they're charging?
The practical answer is to say that I would focus on earning that money to pay it back. But at 19 years old, I borrowed $1.1 million. I don't know how to go earn 6 figures though, working at the YMCA, which was my very first, part-time job. I had to get really good at math. And that's led to what I'm doing today. But all these investment properties that I was purchasing, 12 units or bigger, those are a function of the dividends that they cash flow. So if it cash flows more, it's worth more. And the target was, okay, if I can get the value up because I can get a new net income on the property, I can raise the income that it produces, I can structure new debt against it for long periods of time at much lower interest rates. And so today I've got some 3% money, 4% money on contracts, and I've been able to cash out the original notes. So I don't have any of those original hard money notes on the first 2 12s. I've got one on my 6plex still, but I'm cashing that out in the next 45 days.
So basically, you guys are increasing the value of the buildings to the point where you can get traditional financing and almost wrap the second and the first together.
And that's the goal. I actually did have to pay off the first 2 12s because in theory that plan made sense. I did have to come up with equity to just cash them out. And one way that I did that, I had Christian buy into one of my 12 plexes.
And then how are you guys finding the opportunities?
Everything Cody and I have done, and I think this is the most unique piece that Cody started with. He built a relationship with the seller, but they wanted to sell to him because they were bought into him and helping him get started. And that was the first aha I know for Cody, where I was like, wow, they let me do something really cool. Financing 90% of a deal to a 19-year-old, you don't just do that to make money. You do that because you have a relationship and you're bought into that individual. The broker on the other side of the duplex transaction in Central Washington, he ended up being a guy who actually owns a lot of property. He's done seller finance deals with Cody and I before. He'll offer us deals 90% financed at lower interest rates than he will other people who call him looking for a deal, because he's bought into our mission and we meet with them. He's taught us a lot of what we know about seller financing, and the deals all flow in as a function from that. When people want to help you and you want to help them, it is a much easier way to do business and a lot more organic.
And as an extension of that, I found those people through Google Maps. I found properties, and this is the most simplistic approach ever. It works. People don't believe me, but I find the big roofs. I go aerial view, Google Maps, and I'm like, someone had to get pretty creative to buy that. So then I figure out who owns it. That's where we start cultivating a relationship and learning how they got to where they're at today.
You're setting up like lunch meetings, coffee meetings, and just going to them like, hey, how did you build this portfolio of real estate, and kind of seeking education that leads to a relationship. Then obviously in some cases it leads to deals now or even future deals as well too.
People who own real estate, they know other people who own real estate. Every conversation needs the three parts. We need to be relatable, put forward what is our target and what is our goal and the significance behind it. And if we can communicate those three things succinctly in a conversation, they'll either show you the next person you need to meet or they'll help you themselves. But when people want to move you forward and you're connecting with the right people in the space who own the type of things that you want to own, it all just flows.
What is your goal and what is the significance behind it?
Cody and I have different objectives, but for me, my wife and I want to adopt kids. That's something that we've wanted to do for a while. I originally wanted 2 kids. She's told me the options are 0 or 4. I also want to move to a warmer climate. So we're talking a few years out. How do we move to Texas? And my third piece there is I want to be a great provider for my kids. My dad was that for me, but he traded all of his time. 10-hour work days, 2-hour commute, 6-day work weeks. If I'm going to adopt kids and be their dad, I want to be their dad. I want to own my time and provide. And I was not getting there in the 9 to 5, just working, saving a little bit, getting taxed on the rest of it. So what I'm trying to do is get a portfolio that builds the passive income I need to move to the climate that I want to raise my children in and to be able to provide for my family without the sacrifice of time.
That's awesome. You're basically looking to structure a life by design. That's awesome. Congrats on that. What about you, Cody?
Yeah, I'm in the space so that I can retire my mom. So I'm going to do that this year. Super stoked about that. She's a big role model for me. So I want to make sure that I can get back to her like she gave to me when I was growing up. And I purchased enough to this day. So I get it stabilized. I can take care of her and she's just fine after this year. That's my big goal for 2022.
Let's talk a little bit about seller financing. What are some of like the different structures that you guys have done? Obviously, we know the 90-10 one that you guys did. How long was it financed for? What type of rate was it financed for? Was it interest only? Was it principal and interest? Maybe talk about some of the other structures that you guys have been able to come up with.
So the answer to that is yes, because we've done all of that. My very first deal, they financed 90% for 30 years, no balloon. That was 6%. So I have a 30-year contract on that first 12. Second deal was a 10-year note. That was also 6% interest. 6% was the only number I could think of for some reason. I did 17.5% down on that second place. But then started working with Christian. We bought the 38 plex together. And that deal was 15% down, 4% interest. And we had 6 months where it was a significantly reduced mortgage cost. We basically knocked 30% off the mortgage payment. We went from 10 grand a month down to $7,000 a month. The beauty of that is that was a little bit of principal and interest. It wasn't interest only, but when it rolls back up to $10,000 a month, all the additional payment is strict principal pay down. So we're hammering the mortgage by 50 grand a year, which is not a typical amortization schedule on that size of loan. If you can think it, you can do it on this creative finance stuff. If you want to have it all go to principal, you can. I mean, I've seen people do 0% interest. But yeah, that was our deal.
Yeah.
Are there any benefits to you guys doing it where it all goes to the principal or 0% interest, or are there any benefits to the seller of structuring it a certain way versus another way?
Everyone has different objective. That's part of the relationship piece. Same as when we have to raise capital to do a deal, the investor and the owner have different objectives. I found with some of the larger owners we work with in markets, there's people with 550 units that are owned outright. I mean, whether I pay it in cash or do monthly payments, it doesn't change their universe. The reason that they'll do these deals is because they're invested in us. It goes back to the relationship piece, but everything on putting these together depends on their objectives. With the 38, that's been on market for 10, 12, I think maybe even 13 years. It was on market a long time. No one made it make sense because no one figured out what the owner wanted. And all they really wanted out of it was, we want to live on $10,000 a month. And this property is a thorn in our side. So we just set the principal and interest payments so that it made a $10,000 payment to them.
Which is listening to what the other side wants and basically giving them what they want, in other words.
I wish I had something more profound. It's not really rocket science.
That's good. Why raise debt versus do the syndication model? I know that the syndication model is very popular right now. A lot of people are raising money and then getting a piece of the ownership. And obviously you have operators who run it. Why did you guys decide to structure it this way versus that way?
Not a lot of people have done what we're doing. The syndication space is red ocean right now. We're swimming in a blue ocean. It's not going to be like that forever. People are going to start doing what we're doing. And when that happens, we make a spread. It's cool to go do what everyone else is doing. But I've talked to a lot of syndicators, people that own 3, 4, 5,000 apartment units or more. And not a single one of them knew how to do what I was doing. They didn't know how to structure it. They didn't know how to put it together. They said, that's what I want to do. That's not at any fault to anybody. It's just, there's no information on this online. I got fortunate by actually reaching out and cultivating relationships with people who have done this over 50, 60 years and learned a thing or two. Everyone can do syndication. Not everyone can do what we're doing because people won't make the time to build the relationships. And I found that not only is it more profitable to do it the way we're doing it, it's more rewarding because I am making the impact on communities. It's not like it's this big fun, but I can grow myself to a point quicker this way than through syndication to where I can actually go impact the communities the way I want to.
Not only that, but you get to keep more of the pie as well, too. You're not giving away a bunch of equity as well, too, when you're raising the debt versus doing the syndication model.
The rules are a little bit more custom, like whatever we agree upon for their targets, we can match that. It's a little easier than mass marketing for syndication. We had an investor whose sole goal was, I want to double my money every 5 years. I'm pretty good at losing money when I try real estate myself. So I want to place it with someone who can double my money every 5 years. These deals cash flow nice day one. We're going to take 100% of the cash flow for Cody and I, and your buyout is a 2-to-1 in 5 years. You exactly hit your goals. And I get to keep cash flow that I need today, but it's a true zero down deal where all parties win. I don't get that same level of creativity when we're playing with syndication and SEC rules. You don't get to have those experiences in that space.
What I'm getting out of this is go out and build relationships. Don't make it all about the deal. It's more about building the relationships and actually listening to other people's goals and then trying to come up with some sort of creative structure where you're able to accomplish both of that. My next question for you guys is, do you guys ever get pushback? Because are these people in second position? Do you guys ever get pushback on that?
Well, it depends how you structure the deal, because I've done second position. My very first and second deal were second position. We found ways to structure it where the security is the ownership. And this was a lot of long calls with an attorney. So I couldn't accurately portray it over this, but through a lot of long phone calls, their security was the ownership and the asset, where if we fail to perform, we forfeit our ownership. On a deal like the one Christian was talking about, where they fronted the down and they get a 2-for-1, we get 100% of cash flow for 5 years, meaning worst probable case, we lose the asset. They take over the asset. They're getting a great cash on cash return, and we got 5 years of free cash flow. they got their equity bump because they took over ownership of an asset that we bought on, 5 years ago, dollars at that point. They're buying in at that cheap price. Best case is we have a deal that pays for itself. Point of this being is not everybody is always in second position. Typically today that we're not doing any second position. We had to get really creative, but we found structures to where it doesn't actually show as a lien because it's not a lien against the property.
What are some of the challenges that you guys have come across as you guys are obviously building the real estate portfolio? I imagine that it's not all roses.
Yeah, I mean, there's a lot to it. We had a truck drive through our 38 plex, our roof that I had someone work on getting replaced, and there was an unforecasted storm that decided to sweep through town when the roof was off. It was supposed to be sunny. It was less than sunny, and all my apartments flooded. And not everything goes as planned, and that's okay, because I'm not buying this to flip it tomorrow. I'm buying it to hold it forever.
Most of the unknowns are just people and maintenance. I mean, anything that comes with owning a building.
What are you guys looking for when you guys are buying these apartments? Is the seller financing the most important piece of the puzzle? Is it the number of units? Is it the value add? Are you guys looking for a combination of things, or what is the ideal model for you guys?
Looking for property. This is something I've had to share with folks. When people quantify deal, they're quantifying a piece of real estate. That's not what I refer to when I'm talking about a deal. When I think of a deal, it's like the individual is the deal, and that compounds when you add another individual to the situation and you make a relationship. Our typical deal is a coffee or lunch get together where we learn the knowledge piece and the application, which is really the most important piece. And that's why we have an unlimited pipeline. It's when you don't look for things, it's kind of like a relationship. When you're not looking for a relationship, you find one.
Yeah.
And when you're looking for one, you never seem to find the right person. When you're looking for a piece of real estate, you find what you look for within reason. But I've found that when I just target relationships and I try and build a genuine interaction, that just compounds and brings in so many opportunities that I wouldn't even know what to look for.
Correct me if I'm wrong. The same people that you're building the relationships with are the same people that are selling you the deals, but they're also the same people you guys are raising the debt from. Is that true or no?
It goes full circle. So, I mean, you get seller finance debt from one person, you get down payment debt from another. But I'm building relationships with everybody in different life cycles. I mean, everyone's at a different point in their life cycle. And so we have to meet with, the investor side and see what they want for the down payment debt. And we meet with the seller and see what they want. But more so than focusing on a piece of real estate, we're focusing on learning from people that have purchased real estate. That is the overarching concept that I've held true to this day. It's just, I do not look for real estate that often. I look for people that have purchased real estate and try and figure out how they did it.
Two options of what you can give up is you can give up future equity and you can give up cash flow today. So if someone, if you have a deal that cash flows really, really well day one, it's easier to raise it as debt, where people who want monthly cash flow, that's probably the people who I'm in a relationship, I want to line up with that opportunity. If there's something where cash flow is a little tighter day one, but there's huge upside by managing the property correctly and raising rents, that may be a better lineup to that deal. So I don't have to sacrifice as much cash flow day one. Our two things we're solving for is, if we're buying it, how do we own it and how do we keep it, provided it's in an area that we want to own?
Now, how are you guys selecting like who to build relationships with? Because I imagine that you guys aren't building relationships with everybody. Is there like a formula there? Do they have to have like certain amount of assets? Do they have to have a certain amount of net worth? Is it just, hey, look, you look cool, let's go have coffee?
That's about as simple as it is.
Yeah.
I'm not focused on people's net worth. I met a guy recently. He's like, I don't talk to anybody worth less than 5 mil. And that it's such a bad mindset. It's limiting, because people that are worth less than 5 mil today may be worth $1 billion next couple decades. We don't quantify or qualify people based on how much. We just find something that's cool. And it's like, you did something I don't know how to do. And I think that's amazing. I'd love to buy lunch.
What would be an example of something that maybe like a cool like lunch that you had on something that you wanted to learn about and you were able to have lunch with them and educate you on that?
So there's a 15 plex across the street from one of my buildings. They own quite a bit of real estate, but I bought this 12 plex and I looked across the street and saw them. I was like, oh, they are neighbors. Call them up. Hey, neighbor, curious how you did that property across the street and, gave them the address. I just want to let you know, I just bought this 12-plex. We're neighbors and younger guy just trying to figure out how to make my way in the world. We booked a meeting. I just asked him, I was like, how did you do something like this? You bought this 40, 50 years ago. What'd you do? He said, well, the seller financed 100%, but they wanted equity in the deal. So they financed 80,000 against the property, and I had another little property, and they put the remaining balance against the little property. So I bought it with the signature. I had equity in this asset. I had equity in this asset. We just put a second on the other one and a first on this, and boom, I bought a building. That's and then awesome. They used that 15-plex as their piggy bank because they had equity in it. They could pull some money out and buy something else, and pull something out and buy something else. And they bought a huge portfolio, and that paid off all the debt.
Lessons that you guys have learned throughout, or things that you guys maybe would not do again, or anything that maybe has any advice for any of the viewers?
Be extremely, extremely strategic about who you partner with. It is shockingly easy to raise capital. And everyone who's bought any significant amount of real estate has figured that out at some point is, wow, there's more money than there is deals. That's not a reason to partner with everyone. I know Cody's had some rough partnerships early on. I've had rough partnerships in other ventures. We had a deal fall through just because we had nothing wrong with the person. They asked too many questions, and they were obviously going to get very nervous and be high maintenance the whole transaction. Something I learned is, even when you can partner with everyone and you can raise all the money in the world, just because it makes money doesn't mean it makes sense. That's something Cody learned really young. I learned young enough. I don't want to have to learn that lesson twice.
What would be some red flags for you guys now, knowing what you know?
For me, if someone's not completely honest with you up front, like to some extent, everyone will lie. It's good to know how much someone will lie. But if you just get thing after thing up front where you're like, I don't feel like what they're saying is true, just don't do it. Like if it doesn't feel right, don't do it. If you're taking the steps you're supposed to be making, stuff just starts working. Cody and I will look at each other in the car a lot and be like, I love our existence. This is insane. How did that work? We've had a couple of things we tried where I'm like, this is going to work. People are going to buy into this, and absolutely nothing. I'm like, okay, the things that are not working, I'm just not going to do.
And some of those were ventures with other people. When Christian and I set out to start a little company, and we monetized it within a couple hours. And then we're like, well, that was cool. Let's see if we can do it again. And then we monetized it the following day. And we were able to scale it up. When you work with the right people, things will work. When you're working with people that, they're telling you all these great things, but nothing actually happens as a result, which is something that I had to learn through some of, my beginnings, that's a red flag.
Can you give us an example of it? Maybe of like a specific situation where...
I would have to think that through. We can't give away specifics because that would give away what it is.
We're thinking about the same one. I don't want to throw anyone under the bus.
Perfectly fine. Not a problem. Cool, man. Where do you guys see yourself in the next 5 years?
Christian's going to be down in Texas. Probably have kids.
That would be nice. That's the goal.
As far as real estate goes, probably have 1,000 units. Family's going to be taken care of. I'll probably buy a house. I don't qualify yet, so maybe in 5 years, we'll see. It's a long time because 5 years ago I was 17, so a lot can happen. We'll see. I know it's not linear. I want my family taken care of.
Christian,
I want to keep scaling this. Like Cody said, we want to, at the pace we're going, 1,000 units is completely realistic, and I want to do that without syndicating because one, I believe we can. Two, Cody met with Grant Cardone, and Cardone told Cody he can't scale this. So I kind of want to just prove that. Love Cardone.
Wrong.
Yeah, he was just wrong on that one thing, and I would like to prove him wrong. I want to keep scaling. I want to build this. And Cody and I have a small consulting group. I want to really scale that out. I want to do something that's so big and incredible between Cody and I that we can turn around and show people like this is what is possible and help other people get out of the 9 to 5. There's a lot of ways to make money. This is one that we've found that works. I like it better than a lot of the other methods out there, but I want to build something huge and show other people how to do it.
Well, I've enjoyed obviously having you guys on the show. For all our viewers, this was episode number 98 of the Residual Real Estate Agent Show. If you've enjoyed this interview, make sure to hit that subscribe button. Last thing, where could people go about to find you guys if they've enjoyed the content?
We're both on Instagram. Mine's Cody D 2020, and Christian was gifted with just his name, Christian Osgood. As far as YouTube, we do post on there. It's Cody and Christian. If you put Cody and Christian Real Estate, you'll find us.
Shows up online as Cody and Christian Multifamily Strategy. But yeah, follow us on YouTube. If you have any questions, message us there or on Instagram, and we are as active as we can be.
Awesome, guys. Well, I've enjoyed having you guys on the show. Thank you for taking the time and for sharing. I appreciate you guys.
Thank you.